Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday hosted by the Cal State Bakersfield Small Business Development Center. This is webinar number 352, and we got a great program today, and let's just get rolling with it. Thank you so much, all of you, for being with us today on July 30th, 2025. There is SBA lending, guaranteed lending programs. And we're going to get into that a great deal today with our special guest, Craig Howells. And he'll be joining us to talk about what it looks like to get an SBA loan approved in 2025 and discuss a few of the changes that have been happening in 2025. We'll do our regular economic corner, which generally looks at the economy, and also our Capital Quarter, regular features of Webinar Wednesday. We'll get into a little bit of that. We'll tie the Capital Quarter to today's presentation. We'll have a little bit more news and information and resources to help you thrive. There will be answers to your questions live after today's presentation. So please, if you have a question, go to the Q&A box, and we'll have time at the end of the presentation today to take your live questions. We'll have resources in the chat box. Maureen, our Webinar Wednesday producer, will be there manning the chat box and putting a lot of resources that you can grab on the fly, resources that'll help you with your particular business. And let's do a poll today. Who doesn't love a poll? So our poll today, a couple different questions. We'll start with, since I'm kind of in an optimistic mood again this week, it's been happening for quite a while. Optimistic. I want to know what you are optimistic about. So what are you optimistic about for the remainder of 2025? And you only get one choice here. So is it the opportunity for greater sales and profitability? Is it improved cash flow in your business? More opportunities, expansion? Is it resilience and just surviving what's going on? Or if you have something else to add, please add it to the chat box and you can go there. So anything else that might go in there, feel free to utilize the chat box. But what are you most optimistic about for the remainder of 2025? Again, your choices: greater sales and profitability, improved cash flow, more opportunities. And there's also a lot of opportunities out there for expanding your business, etc. Resilience and survival, or others, go to the chat box. Or if you're not feeling particularly optimistic at all today, hopefully you will by the end of today's webinar. So we do have 63% of you participating. Give you a last moment to jump in to what you're optimistic about for this year. And we'll close the poll. Thank you, you 65% that are optimistic and actually participated, and share the results with you. And 40% are looking for opportunities. You're optimistic about your opportunities to expand, etc. That's fantastic, 40%. 28% of you are on the resilience and survival bandwagon. We do have another 16% that are optimistic about greater sales and profitability, 12% improved cash flow, and we also have another that will check the chat box in sometime during today's webinar. So we will stop sharing that particular question and move to poll question number 2. Yes, multiple poll questions today. And our poll questions are a little bit different moving forward. So let's kind of look and see. Launch poll question number 2. And it has to do with interest rates. And it's the Federal Reserve Chair doesn't have the authority to change interest rates. How many individuals decide that? The Federal Reserve Bank, they met just recently, actually this morning, and within the last hour came out with news that we'll share in a little bit, breaking news on potentially interest rates changing or remaining stable. So we'll get to that particular point, but there is a number of individuals, not just one, who actually make that up. And is that 3, 7, or 12? 3 choices here, just 3. Federal Reserve Chair, is one of the 3, 7, or 12. But how many? Is it 3, 7, or 12? Decide. Okay, our whimsical poll is up to 65%. It's great to have that much participation. So what we're going to do is we're going to jump in and give you one last moment to Google the answer and to respond correctly to this, I think, a difficult poll question. I don't know if I would have got it before this. I doubt it. But we'll go ahead and end the poll. And with 72% of you participating, 38% of you think it's 7. I think I would have answered 7 if I was given this poll question yesterday. But no, the correct response is 12. 34% of you said 12, along with 28% of you saying 3. So it is 12 individuals that consist of 7 federal, well, I can't. Let me get into that in just a minute. Oh, it turns into 7 federal governors, of which the Fed chair is one, and 5 local bank chairs, such as the Federal Reserve Bank of San Francisco, Atlanta, etc. So let's go back and put our last question. And our last question is going to be, what is the term for those 7 Fed governors or 6 Fed governors? Is it, little technical difficulty right here. Let me go back here. So this question is really got to be great for it giving me this much trouble. So our third question, after much ado, is what is the term for the 6 Fed governors? So 6 of the 12 are federal governors that are actually the Fed governors are appointed by the president. And they're given a term. Is the term 4, 9, or 14 years? So the last, and another, I think, pretty difficult question I'm hitting you with. The pop quiz question of Webinar Wednesday's poll questions. What is the term for the 6 Fed governors that have been appointed by the presidents? We have, I believe, one that was appointed by President Obama, 2 or 3 by, I think it'd be 3 by President Biden and 2 by President Trump. What is their term? And I'm going to give you one last response, one last breath to jump in. And with 66% of you responding, thank you for your response. We're going to jump in and end the poll at this time and share the results with you. And 37% say 4 years. Yeah, that's maybe what I would have guessed. 33% say 14 years, and you're correct. Wow, what a great gig, huh? 14 years. 33%, and then 30% of you said 9 years. So thank you for our Federal Reserve portion pop quiz of Webinar Wednesday for this week. Okay, moving right along. Our Capital Quarter, which is a regular feature here on Webinar Wednesday, which is the resources for funding your particular business. And so Capital Quarter, since we're getting a heavy dose of capital this week, we'll talk about our Federal Reserve Bank connection and also ways to know your cost of capital, which is important, knowing what your cost of capital is if you have multiple debt or equity arrangements, situations when a refinance might come into play, and funding a transitional business, all on the Capital Quarter here. So first of all, here's our connection is we were a participant in the Federal Reserve Bank's annual small business credit survey. And this particular question, we had 109 of you Webinar Wednesday responders respond to it. 6,000 nationally, and the blue, the almost near CSUB blue, is our local territory, our 3 counties, 109 respondents. And it shows what products were sought over the last 12 years, which were credit cards, a loan, potentially an SBA loan there, line of credit, trade credit, something we don't talk about a lot, extending credit if you have terms, a merchant cash account, and also a lease. So we see that we are above average on the credit card usage, a little low on lines of credits, about the same as the number of loans. Merchant accounts are a little bit higher as well. So that's how we reflect nationally with our region here. With credit cards being high, that should be factored into what your weighted average cost of capital is. Now, here's the formula that I believe is taught over at CSUB. I get some bright students that come in here and I ask them about, hey, what is the weighted average cost of capital for this client here with four different options, four different lending options going? And this takes into effect a corporation that might have equity. It's too complicated. So I just do it this way. I pull into my Excel account and we look at the various loans that they might have. In this particular situation, you see five different lending options that they've had. So at this point in time, these five loans represent different interest rates, as you see, that go between 3.75% for a COVID idle to a merchant account that could range, at 42.45%. So what are you paying for capital if you have such a wide range from 3.75 to 42%? Well, we take the balance of that, which will then give us your percentage of the total debt. For the COVID, it's nearly half, 136,000 of your outstanding debt of 314. And then we apply the factor of how much of that is applied to that interest rate. So then we're able to add them all up. And you see the merchant account at 58,000 is almost 8% of your 13% of debt. So really kind of skews everything higher, having a high interest rate product like that. So, but really understanding and knowing your capital cost is something the SBDC can help you with. Now, let's say you took those five and you consolidated four of them into an SBA loan. Potentially your business is growing or expanding. You're one of the 40% that saw that you have opportunity and you want to get some permanent working capital. So we added $100,000 of permanent working capital, paid off everything else. Maybe I thought the interest rates were going to soften today or go up. I don't know, with 10.5%. But you see that that's now 2/3 of the total debt of the business, whereas the COVID idle is 1/3. But it drops your interest rate all the way down to 7%, all of your interest combined. So we're going from 13% with this scenario. And then all we do is we refinance all four of those and add $100,000 more that you take out for permanent working capital to grow the business. And again, this is going to be a growing business situation. Those are the ones that lenders like to see. So we look at that as far as 7.05%. There's also a scenario to where you can buy a business with zero down. We don't see it very often, but with businesses transitioning these days, and you have an SBA loan and the owner financing, everything really needs to be super solid in this. So whereas you might not have the capital to inject, this was an area to where in the past, Mr. Howells would work on a particular deal like that. And since most lenders are cash flow lenders, I'm not going to miss the opportunity to bring up our cash flow forecast. And our cash flow forecast just basically demonstrates your ability to show a positive cash flow, that cash position at the bottom of each month to where it's growing. And we're in the process of having this updated. If anybody would like our version of what we think is the simplest cash flow forecasting method out there, here it is. And in this basic Excel spreadsheet, it's a little more complicated because we'll also send you the assumptions, because it's important to be able to identify what assumptions you are using to come up with your cash flow forecast. I like to say I can forecast that all of your businesses are going to make $1 million, but you haven't seen the assumptions yet. So believable, valid assumptions play a big part in that. The Federal Reserve held interest rates steady. This just came in the 11 o'clock hour this morning. And of note, though, for the first time since 1993, two of those Fed governors who we talked about with their 14-year terms dissented from the majority decision, voicing support for a rate cut. So that has been 32 years since more than one Fed governor has dissented from the majority decision, which was this morning to hold rates steady. And rates are determined by the Federal Reserve, affect all rates or most adjustable rates in the economy, everything from auto loans to business loans to credit card debt and so many other things. So, whereas, you know, the economy in general, uncertainty is still a factor. We had some great economic news today that growth is at 3.0% in the second quarter. Economists had projected earlier, and maybe they still are, that economic growth for the entire year of 2025 is going to be around 1.5%. But for the second quarter, it was 3%. Consumer confidence has improved in July. And to quote Jamie Dimon, the CEO of JP Morgan Chase, yes, we are basically in a soft landing now. Yes, a soft landing for a long period of time. There is, something that I just learned to love earlier with an earlier webinar, the $100,000 bill. And maybe you're looking for a $100,000 loan. But last week after passage of the HR1, the Big Beautiful Act, which is also called the Big Beautiful Bill, those that were on know that I like to call that the Big Beautiful Bill, because how can you get any bigger and beautiful than that bill? But we suggested business owners do a variety of things, and those are to look at your plan for this year, review how that Big Beautiful Act is going to affect you. Look at your financial risk risk and security, and also HR. We tout our free human resource hotline that is provided through the workforce development boards of Central California and provided by the California Employers Association. There are some numbers that you can contact them. Really, the beauty in SBDC consulting is all these great, fabulous tools that we have. We're going to start putting some of our student interns from CSUB, from the School of Business and Public Administration, maybe get rid of the logo, put the picture of some of our students up there, because they're a great resource now for businesses that want to do live plan, want to get into some industry analysis in vertical IQ. Our CSUB YouTube page is wide open, ready for you to jump in. We're up to now, I believe, we're approaching 500 subscribers. Yes, there will be some type of award or prize to our 500th subscriber. I believe we're around 460, 470 right now, but it's a great way to get this webinar in your email box to you each and every week. And again, our Webinar Wednesday sponsors, we're proud to have every one of these along our Kern County, California, powered by SBA, State of California Office of the Small Business Advocate, Blue Tech Valley, CenCal Business Finance Group, and the College of Business and Public Administration. Contact us with any questions if you want confidential, no cost, no obligation expert consultation. And that brings us to our special guest today. And our special guest is Craig Howells. He is the SBA Division Manager at our Bakersfield-based Mission Bank. He has more than 30 years in banking and finance. He knows how to get deals done. Trust me, we've done plenty with him, including working at the SBA Fresno Commercial Loan Servicing Center and a variety of other financial institutions. He SBA manager at Suncrest Bank, great skilled in commercial lending, banking, credit analysis, a lot of other things. It's been 3 years since he's been on Webinar Wednesday, although an active participant in our Capital Summit series that we do. Craig received his MBA from Fresno State University, a BS from the University of the Pacific, where he lettered in swimming. Craig, it's great to have you join us today. Take it away, my friend.
All righty. Good afternoon, everyone. As Kelly mentioned, I am the SBA Division Manager of Mission Bank. We're headquartered out of Bakersfield, and it's a pleasure to be here this afternoon. So thank you for taking time out of your lunch to listen to us this afternoon. Kelly already mentioned my background. So I am the SBA Division Manager at Mission Bank. I've been here for 3.5 years. I'm very happy with Mission Bank. They're a community business bank headquartered out of Bakersfield, California. Let me give you a little commercial on our bank. Our bank was established in 1998, so we're about 26, 27 years old. I am what you call a PLP lender, which is a preferred lender provider, which allows me to submit loans and seek SBA approval without going through the rigorous process of having them underwrite the loans. So it saves you time. We have locations in Bakersfield. We have 2 there, and we have Shafter, Ventura, San Luis Obispo, Stockton, and Visalia. We are in the process of opening a second location in Ventura, but we are currently in an expansion mode. So we are looking at opening offices elsewhere in the state of California as we speak. So we're just under a $2 billion bank, which allows us to provide financing for basically all your needs. And just to give you a little bit of background on our department in particular, as I mentioned, we're a PLP lender, and the people that work with me, there's 2 others that are in my unit, and we have well over 50 years of combined experience. And so we're here to help you get SBA loans and make them easy to. A little bit about our bank. We are a high performing bank. So you are in good hands with our bank. We are always ranked highly by all the different polls in the different organizations. So anyway, our objective at Mission Bank, as far as my unit is concerned, we're here to provide financing to qualified small businesses by offering SBA loans, which typically have longer terms, less money down, and at favorable rates. So let's jump right into it here. The SBA 7(a) loan program, as Kelly mentioned, some changes took place that became effective on 6/1 of 25 of this year. Let's just start off with the basic eligibility for 7(a) loans. You must be an operating business for profit, so nonprofits can't get SBA 7(a) loans. Must be located in the U.S., and then you must be small, as defined by SBA size standards. And we'll get into that in a few minutes here. And you must be not an ineligible business. And then we'll talk about that briefly as well. And then probably the last point, most lenders call it the credit elsewhere test. And it basically pertains to the fact that you couldn't get the same loan conventionally. Without the assistance of either a state, federal, or local government loan program, because they want to help businesses that are having more difficulties. So the SBA, so the basic eligibility for SBA loans are, so it's defined by the, I'm sorry, my printer is going off right now for some reason. So basically, to participate in the SBA loan program, they use the NAICS codes to determine the size standard. And the NAICS codes are usually a 6-digit code, and a lot of people have it on their tax return. 7(a) loans, there's various 7(a) loans out there. And the SBA kind of breaks them down by uses and types. So the SBA Express is a revolving line of credit program, but can also be used for term loans. And with that program, the maximum loan is $500,000, and the bank in turn gets a 50% guarantee, and loan terms can be up to 10 years. We primarily use it for businesses that need a little extra help and they want a revolving line of credit. The next loan program that's probably the most popular is the standard 7(a) loan program. And standard SBA standard loans run from $350,001 up to $5 million, which is the max. It's a non-revolving loan program, so these are term loans, and you receive a 75% guarantee on these loans. Interest rates are at 3% over the Wall Street Journal Prime is typically the max on this. And for loans in this dollar range, and 350 to 5 million, the SBA requires that the bank try to take as much collateral as possible up to being fully secured. So what that means basically is we'll take a look at the business assets, we'll apply liquidation calculations, and if we come up short, we may be looking at taking equity in a property that you may have. If you don't have anything else, we could still make the loan. So you're not pigeonholed into always having to have full collateralization. In situations too, the SBA may require that we get life insurance for a shortfall. So we may be asking you that. So and term insurance is acceptable. So you can get some pretty inexpensive term policies out there to help shore up the collateral. The SBA small loan is for loans up to 350, and under that category would be loans up to 150,000. The guarantee fee is 2% of the guarantee amount, and then for loans that are greater than 150,000, there would be a 3% guarantee fee. And these are non-revolving loans, and rates are typically 3% can be up to 3% over the Wall Street Journal prime rate. As far as collateral is concerned on the SBA small loans, loans up to 50,000, we're not required to take collateral, but loans 50 to 500, we're supposed to follow our bank's required collateral requirements. Alrighty, and then I just threw this in here. These are kind of like hybrid 7A loan programs. They're not used a lot, but I just will throw it out there. They have the Export Express, which is a revolving line of credit or term loan that is used for developing export sides of businesses. And then they have the Export Working Capital, which is basically to provide working capital exporters. And then lastly, there's a thing called the International Trade Loan, which is to help existing exporters, and then to help exporters trying to develop new markets. So these are some, like I said, hybrids that aren't used very often, but they are under the 7A loan program. This sheet here basically shows you kind of the maximum rates for SBA loans. And you can see here that basically it's prime plus 3. And these loans, Wall Street Journal prime currently is at 7.5. As Kelly had stated earlier, there was no change in the rate today. And then I would like to mention here that you can see the terms, if you're purchasing real estate, can be up to 25 years. So SBA does have a prepayment penalty on loans 15 years or longer, and that prepayment penalty would be 5% the first year, 3% the second year, and 1% the third year. You are able to prepay up to 25% annually on those loans without incurring a penalty. So the prepayment on these SBA loans are typically shorter than what you would find on a conventional loan. A lot of conventional loans may have a 5 to a 10-year prepayment penalty. So keep that in mind. Typical eligible businesses under 7A are the following: hotels, restaurants, contractors. These are typical uses of this loan program. I will go on, I will tell you that most of the hotels at one point were financed with an SBA loan, whether it's 7A or 504. And then the gas stations are the same thing. Most of those businesses have sought financing from the SBA to get started or to get built. So very important loan program for these types of businesses. Ineligible businesses, I won't read them all, but I will tell you this, that obviously at the very top, nonprofits are not eligible for SBA lending. And then the rest of it is just, you can look at the slide at your own leisure, but these are the now ineligible businesses. And then next, I want to talk to you about kind of the areas that we look at when we're looking at an SBA loan. So what we look at is primarily, as Kelly had mentioned, cash flow. We want to see that you have the ability to repay the loan. Collateral is nice, but we want to see either historically or on a projected basis that the business has the ability to make to repay the loan in a timely manner. So another area we look at is collateral. Not only are we required to by the SBA, but it makes the transaction stronger. So the more collateral you have, it does help the transaction a bit. We do look at financial ratios, and I just threw a few here that are some of the common ones: current ratio, debt to worth ratio. These are ratios that what we do is we will take your industry and compare your numbers to the industry averages, and we will make comments within our credit memo, which is kind of like our book report when we do a loan. And this is to kind of show how you compare and then maybe why there's any differences. And then also key is management experience. We want to see that you have some experience in the industry you're going into, or that you partner with somebody that has that experience. And then credit history, I just threw in there no government debt defaults. That pretty much will knock you out. We have to do a search, and the SBA does a search as well to see if you have any student loans that are in default or you defaulted on. If you had an idle loan that you defaulted on, or something like that, that could knock you out of the program. So these are the things we're kind of looking at, in the financial analysis. As I mentioned, we're going to ask for the last 3 years tax returns and an interim financial statement from you. We're going to do a thing we call it spreading, which is basically taking all the data, putting it into a software program that spits out numbers. And we're looking at debt service coverage of a 115. And what that basically means is that your business should have a 15% cushion after all of its expenses and loan payments. So we will be asking for a debt schedule from you. And in the event we're refinancing debt, that could help you achieve these numbers. And then I also threw in here on a one-to-one basis, on a global basis. And that basically means we take into account not only the business debts, but also your personal debts, and roll them all up to get that number, because we want to see you're able to cover that each month. And then startups, obviously these are going to be projection based. And then if we see a business that needs a little help, let's say they didn't, they're on the upward swing, we might ask you to do some projections. And then what we're wanting to do is to see that within 2 years of funding, that the business on a projected basis will hit a 1.15 debt service coverage. And then for construction projects, because we realize there's a ramp up period, that you do it within 2 years. And then one of the last things that we kind of look at is working capital adequacy. And what that basically means is, do you have the liquid assets or the projected cash to be able to operate your business for the next 12 months? We don't want to put you in a position where you're not able to operate your business effectively. So there may be times where we say, hey, we're going to throw on some working capital for you for like 100,000 or whatever, simply to help you meet this requirement. And then this is kind of a basic loan package here that we would be asking of you: 3 years personal and business tax returns, an interim financial statement, personal financial statement. The new requirement is 120 days, not 90 days, so you can have it a little bit older. The resumes, this is where we're going to look at your management experience. And then we have application sheets, which, basically you're going to tell us about your business. And then this other form here, the 4506C, this really is a form that SBA requires us to verify your tax returns. We want to make sure that that the tax returns you give us are the ones you filed with the IRS. And typically when we get everything together and it's complete, most of the time they're not, the applications are not complete. And this is where, we really like our partnership with the SBDC. The folks over there really can step up and help the borrowers put together a nice package that we can look at. So hats off to Kelly and his crew down there on that. I just threw this out here. These are kind of the estimated fees. I hope you can see this, or it's readable here. So the SBA, these are one of the changes, I guess, that Kelly wanted me to bring up. So originally, loans up to $1 million, there was no guarantee fees on. And then what happened is the SBA took a hard look and they saw the number of loans defaulting were kind of on the rise. So what they ended up doing is they reinstituted the fees. So loans up to 150,000, it's 2% of the guaranteed portion. Loans 150 to 700, 3% of the guaranteed portion. And then how you do that is you basically you calculate the guarantee amount. So um, loans up to 150, it's an 85% guarantee. Loans from 150 to 700,000, we take 75% of that and we apply a 3% guarantee. And then loans from 700 to 5 million, we do this calculation here where we have to break it up into the first million guarantee and then after that. We typically charge a packaging fee of 2,500. We don't charge a loan fee, just so you know, you're not allowed to on 7As. And then other fees, if you're doing a real estate loan, you'll have an appraisal typically, and you might have an appraisal fee if we're taking a house as additional collateral. There's environmental reports, and there's title and escrow. The cost of those can vary depending on the complexity, and I would be able to give you some ideas. So I'm going to go quickly through these examples because I'm running out of time here. But here's an example of a typical 7A loan. $1.5 million gas station, they put down 225. Loan amount was 1,275,000, a 25-year term. Wall Street Journal prime +2, you get 9.5. And then the guarantee fee I calculated is this, and the packaging fee is as follows. So you can see the SBA guarantee fee can be a bit much, but you can finance that into the loan. So just so you know. An example too, like a Subway that I did, customer bought it for 450, put 20% down. The term loan is 10 years. And you can see the rate is at 10 and a quarter, and the guarantee fee is calculated here, and the packaging fee is here. So, and then lastly, and then I'll turn it back to Kelly here, here's a medical practice startup I did in Visalia. They needed 250,000 for working capital and equipment. They put 20% down, did a 10-year loan. The loan was secured by equipment and a second deed of trust on his house. And we did it at Wall Street Journal Prime plus 275. And I don't have the guarantee fee here, but there would have been a guarantee fee. And that is, so that is all the time I have at this point for 7As. So I'd like to thank you for your time, and then I'll turn it back to Kelly.
Hey, Craig, why don't you slide up and go to your slide 25 and just talk about the SBA 504 program for a moment.
All righty, I will do that.
An outstanding SBA program. It's not one of the guaranteed lending programs, but still, it's a great program if you're purchasing fixed assets.
Absolutely. So in the 504 program, we are one of the leading 504 lenders in the Kern County area. And so we do a lot of these. And so the basics of the program are they're supposed to be used for to promote growth and job creation. So for every dollar for this one, it's called the SBA debenture, which is the government's portion of the transaction. They want to see one job created. I think it may be for every 75,000 or 100. I'd have to look at that, but the idea is the program is designed to create jobs, and which is great, right? We want to see that. So the program can be used to buy buildings, new facilities, long-term machinery and equipment, and improve facilities. The exclusions are you can't use it for working capital and inventory, consolidating, repaying, and refinancing debt. There are some exceptions now where you can refinance some, another SBA loan or another loan into the program, and then maybe a little bit of working capital in there, but there are some nuances there. So some changes have been made. And you can't do speculative or investment real estate. These need to be owner-occupied properties. Business must be for profit. And then once again, the size standard here, which was mentioned earlier, this is what they use, which is the alternative size standard. 20 million in net worth and then net profit under 6.5 million. And that can be on a 2-year average, is what my understanding is. So here's the structure. And this is what the part I think that Kelly wanted me to get to. So this is a typical structure for a 504. Basically, the lender, which would be in our case, Mission Bank, we would finance 50% of the purchase of a building. And then the SBA would issue what they call a debenture, which is like a bond, and it's through a local CDC. So in Bakersfield, we'd be using a company called SenCal CDC, and then here we have the borrower coming in with 10%. So what you see here is the borrower has to come in with a minimal amount of money. If you did the same loan conventionally, you might have to put in 25 to 30% down. So for people that are strapped with cash or want to hang on to their working capital, this is a great program. And the SBA portion can't exceed 5 million. There might be a nuance, I think, for businesses that are participating in the green program where they can have multiple. But anyway, so that's the basis of the program. So rates and fees, the bank would set their own rates and fees for the loan. The CDC bond debenture, they basically pool all these projects together nationally, and they sell these bonds in the secondary market, and then you get long-term fixed rate financing on the SBA portion, which has been hovering in like the 6.5, 6.4 kind of range for 25-year fixed money for the bond debenture. So, and if you figure the bank is probably in the 7 something range. So if you combine the rates together and do some kind of average, you're looking at some pretty good fixed rate loans for the long term. So anyway, and then like I said, the CDC has their own set of fees, such as attorney costs and stuff like that. So here's an example, and then I'll turn it back over to Kelly, which is, building purchase for $1 million. The bank does a $500,000 first deed of trust. The CDC, which stands, Certified Development Corporation that sells the bond, would issue a $400,000 debenture in second position, and then the borrower comes in with 100. The bank likes these loans because we're in first position at 50%, so our risk is reduced, and the SBA likes these because they create jobs. So anyway, so I will turn it back over to Kelly. Thank you very much.
Well, fantastic. Great stuff. Okay, we've got a few questions for you, Craig. First question, do you have to bank with Mission Bank to go for small business financing?
So the answer is we would, if we're going to be building a building for you, we'd like you to bank with us, have a deposit relationship with us. So typically, we would like a relationship with you. If we're going to give you financing, that would be our preference.
Okay. And here's 2 questions. Are there specific industries or business types that Mission Bank likes to focus on for their SBA lending?
I would say that there's nothing specific. We seem to have a broad interest in all types of industries. As long as the business is, historically, if we're seeing cash flow, and or if you have a good business plan and it's a startup or you're showing tremendous growth. But no, we don't have any particular industries we stay away from other than what the SBA excludes.
Great. And again, what are your lending sizes, minimum and maximum?
So I would say that for SBA 7A purposes, we probably like to do loans at around 100. And then, we go up from there. the with 504s, of course, we can go much higher. The minimum project size for 504 probably would be like 500,000, where the bank would do 250, and then the CDC would do 40% of the 500,000. So, but we're interested in all types of loans.
Great. Well, let's see what else we got here as far as questions. Is there a prepayment penalty on the 504 loan?
So there could be, and most likely there would be. So the bank would set their own prepayment penalty period. Usually they're at least 5 years. The bond debenture, that is issued by the CDC, that typically has a 10-year prepayment penalty. That kind of is a declining prepayment penalty. But yeah, these are long-term types of loans where the investor that buys these bond debentures for SBA, they're expecting a return, so that's why there is a higher prepayment penalty.
What is the average turnaround time from application to funding for SBA loans?
That depends on the complexity of the deal and also on the borrower's ability to provide a complete loan package. But let's just assume that we get a complete loan package, and if there's no real estate involved, 45 days. If there is real estate involved, I would probably say 60 to 90. Especially if we're doing construction or making improvements. But I've done deals as quickly as 20 some odd days for a major hotel. And so, we try to be flexible and work with our borrowers and the broker. So if we know that we need to close a deal quickly, we'll do everything we can to make that happen.
What we'll do is we're going to jump over to the chat right now and go through the chat. And going up from the bottom, if you don't want to leave a Google review, feel free. Craig Howells, there's his contact information. You can contact him directly at Mission Bank. Here's a question. Is that local comparison or is that California? Okay, I'm not sure what context that is in, but that was at around 12:30. So not really sure, Sharif, what your question is as far as local. And again, you don't have to apply if you don't have to bank with Mission Bank to apply, but it's your
Correct.
preference if you do fund the particular loan that you move your relationship over with them, correct?
We would like that, yeah, because we feel like if we're spending the time to give you, hundreds of thousands of dollars, whatever it is, we feel like we're going to earn your business, and you'll want to bank with us because we're going to try to be different than the rest. But yeah, you don't have to bank with us before you apply.
Can you finance RV parks or mobile home parks through SBA?
Those are a little tricky. I would have to look at to see if there's any exclusions on those. You can do those under USDA if they're in an area that has a population base that meets the requirements for being a rural community. So if this gentleman would like, I could look that up and then reach back to him.
Seems like it's a little easier to fund RV parks because those are generally non-transient residents, from what I recall on that. But
Yeah, because
I guess it depends if your RV park has a lot of full-timers.
right, because I think the magic number is 30 days that that people on average need to stay. Less than that is my guess.
Okay, continuing in with the chat, can you email us a slideshow? What we'll do is we'll send you the entire copy of the webinar. It'll come in an email afterwards. It'll come with the resources that we talk about today. You get that whole package in a few days or so. Also in here is information on signing up to be an SBDC client. We had a recent website update, and I see it got you, Maureen. It got Maureen, with the wrong email address to sign up as a client, but it's in there now, the correct one. Our YouTube channel is listed there. So that pretty much widens up the chat. See if anything has been added to the Q&A box. Can you buy down the interest rate on an SBA loan?
Well, it's not like a mortgage loan. So we negotiate with our clients in the event, let's say they're bringing over a bunch of deposits, we might be able to shave some of the rate down as part of that. But yeah, there's really no rate buy downs. We'll
Like
negotiate
on
the
a
rate.
mortgage rate where you would actually pay more money to get.
Pay points or whatever like that. Yeah.
Okay, and our final question is, who do we talk to if we're already banking at Mission Bank on loan options?
Um, so if it's a 7A loan, um, I would be you could talk to me, but also you could go into any of the branches and talk to a business banker or an RM or one of the branch managers, and they could at least have a conversation with you. Or like I said, if you know it's going to be an SB type of loan, you can talk to me. And if it ends up not being an SB loan, we can direct it back to the business banking center where they can help you. So we're kind of work together.
Yeah, I'm sure Mission Bank has a lot of different lending products, and whereas you handle the SBA, there's a lot of other programs that the bank has that might maybe works with existing business owners.
That's correct. That is correct.
Okay. Well, that's going to do it then. We got a wrap here for webinar Wednesday number 352. Big thanks to Craig Howells for joining us. A lot of opportunities out there with SBA lending, a lot of great programs, a lot of great resources. Any way we can help you here at the SBDC, let us know. So, for my very good friend Craig Howells, I'm Kelly Bearden. We will see you next week on Webinar Wednesday. Goodbye,
Thank,
everybody.
thank you very much. Appreciate it.